Hi, good afternoon, everyone. I hope everyone's well. I'm in the seventh session. Number seven is always my lucky number. So, without further ado, I just want to thank everyone for joining this session. My theme for 2021, as I was trying to prepare this with the team in December, was to think about how to position our portfolios to our client base, especially guys like you who have been invested in us for quite some time. And for those of you who don't really know us yet, right? And think about how then do we navigate in this environment post-pandemic and also via the current environment where we think about the continuation of the recovery that we're seeing, and also on the themes of the revitalization of some of the markets and economies that we look at, and also to focus a little bit about how we think about the world going forward in terms of renewal. And also a little bit more sexy stuff like the Roaring Twenties, where I start to compare the current next decade with the 1920s, where we had a big boom market at the time. So without further ado, I just want to quickly recollect what happened last year. People forget that we actually went through a very deep recession in the first half of the year, right? Where markets tumbled and fell quite substantially in the first quarter. And obviously after that, we had a QE and we had a massive rally in equity or risk assets, as they call it, across both developed markets, Asia, emerging markets, and China, where we've been very bullish on for quite some time. Over the last 1 to 3 months, what you have noticed is that Asia continues to rally, particularly in ASEAN, where you had about 25.8% of its rally. You've had also the Korean market up 23%, and also the Malaysian market up close to about 8%. So the obvious question is, what do you do now after a huge rally in March 23rd at the bottom? What do you do your money now? What kind of teams that you want to invest in? So I will try to elaborate a little bit that in the coming slides, but more importantly, to basically address the issue of COVID-19, for example. You know, a lot of people ask me, you know, the question, and how on earth do markets continue to rally, and how do economies continue to recover when the number of COVID cases continue to rise globally, right? As we navigate in Malaysia or even in Asia or even in Europe and US, for example, the number of global cases continue to rise, number of deaths continue to pick up as well. But we are hopeful with the advent of vaccine, for example, right, that it will continue to flatten the curve, and more importantly, it will reduce the number of cases. So we have always heard in November itself, post the US elections, that Pfizer itself came out with the Pfizer vaccine, for example, and Moderna as well, and the effectiveness is close to about 95%. It remains to be seen basically how much. I think the big assumption on the recovery going forward is the fact that how many people out there, the millions of the people like ourselves, right from the front line, how many people of us will actually take the vaccine, how effective it will be. I think that's a key assumption that markets today are starting to think about, especially after the rally, right? And I think this is something that we are watching out very, very closely, because at the end of the day, if this vaccine do not prove to be effective and it does not flatten the curve, then all bets will be off, and therefore this rally may start to falter a little bit. But for now, I think the market continues to rave on, and I think there is expectations because of this vaccine story that there is a lot of hope for the vaccine and the upcoming fiscal stimulus by the US government, particularly, where they've just announced, for example, 1.9 trillion of fiscal stimulus, that it will lead to, for example, a 2.8% recovery in the US GDP. And also nearer to home itself, where China reported about close to about 2.3% of GDP at the end of 2020, rising by 6.5% GDP in the last quarter of 2020, that there will be a big rebound in the economy by 8.6%. China, as you know, is the largest market in emerging markets, and therefore is very, very relevant for the other export nations like ourselves in Malaysia, and also for Taiwan and supply chains across ASEAN. So I do think going forward, right, in this kind of environment, where we have already had the biggest overhang, which is basically the US presidential elections be removed. President Biden has just been inaugurated as a new president about a couple of days ago, that there will be basically a lot of fiscal stimulus. particularly in an environment where the US economy is still struggling a little bit, particularly in a very acute virus environment, right? And so I do think that when this policies are implemented itself, we do expect, for example, tighter regulations in the medium term, for example, that will contain growth and inflation. But more importantly as well, I do think that Biden itself will be focusing very, very quickly on sustainable initiatives. You're probably going to be hearing a lot about this going forward. On his first day at job, he already signed, the US government already signed the Paris Plaza Initiative, basically to incorporate, for example, green energy initiatives and so forth. So I do think that the winners that we want to focus in our portfolios going forward, obviously, will be on climate control, clean energy, electric vehicles, and green tech, for example. And I do think ESG initiatives going forward, which I'll talk about the later part in the slides, that I think this will continue to be a major, major initiative, not just in Europe itself, but also starting to happen a lot in Asia itself, right, including Malaysia. And I also do think that what is really also going to change, hopefully as well, is the approach by the Biden administration towards this is a very key assumption. A lot of overhang has been priced in by markets initially, but I do think that the Chinese market today, as you can see, in year to date, is up by close to about 10% or 8 to 10%, depending on which market indices you look at. And many places rallying on the back that there is going to be a softer approach by the Biden administration, although I do not think that they will remove completely their bipartisan support against China, but I think the rhetoric may started to soften a little bit, and we're hopeful because of that, the China equity market continues to rally and lead the rest of Asia, if not emerging markets. So without further ado, I just want to talk about our recovery expectations and where we see opportunities. Our key assumption here, when you're in a recovery mode, you need to focus on value and income opportunities. And where we see value and income opportunities is basically in ASEAN markets as well as small caps. But before we get there, you can see in this chart down here, where we initially in the first quarter of last year, you see a huge amount of outflows going out of Asia. And recently itself in the fourth quarter, especially after the US presidential elections, you start to see, for example, a huge amount of inflows going to emerging markets, particularly in Asia itself, North Asia, particularly where you get China, Korea, and Taiwan outperforming the rest of Asia. I do think that this trend continues. Anecdotally, as we speak, the last 2 weeks have seen the biggest inflows from what we call southbound inflows from China onshore to the Hong Kong market. As a result of that, you've seen the Hong Kong market basically recover quite substantially. Although a lot of people say that it's because Jack Ma came came on media and so forth. But to me, seriously, I do think this is a real retail market out there that is driving and also huge amounts of institutional flows from foreign investors going into the North Asian markets that is fueling the Asian stock rally as we speak. I also do think that you cannot have a rally in markets without looking at, and I'm a big believer at the end of the day, those two matter. And so hence, what we are saying here is that although US technology sector has done very well, if you can see here on the left-hand side, where earnings forecast, the market itself has surpassed earnings forecast. We do believe that investors like yourself need to start focusing on the right-hand side here, where earnings expectations are much higher than what the flows are showing yet. So in simple terms, what you want to be invested a lot more here is on the right-hand side here, where it's either Asia, Japan, or emerging markets, or even small cap companies across the world, right? Where I think there's a lot of value. Hence the reason why we think that the value sectors, as some of the other participants in the call have been talking about, is the fact that there is going to be a rotation towards value sectors when the recovery continues. And you've seen that happening in November and December, where people forgot how to price banks, and the banks have started to re-rate substantially. And so I do think this trend will continue if we do expect a recovery in the third, fourth quarter of this year. With vaccine hopes coming on board as well, we also see a lot of value in those cyclical sectors, whether they are going to be, for example, the energy space or in industrial space, and all the other ones in basic materials that are geared towards a recovery. We do see pockets of opportunity down there as well. The other interesting sector that we are hopeful at some point, although it's still fairly early days because number of COVID cases continue to rise, is the fact that Asia is home for a lot of tourist destinations, particularly in ASEAN, for example, with Thailand, Singapore, and Malaysia, and so forth. And I do think that the countries that have the biggest exposure towards tourism sectors, for example, may start to re-rate. For example, Thailand has rebounded about 20% from its lows recently in the last 2-3 months, and it continues to outperform. And I do think there's a particular opportunity where we want to invest in there as well. And I also think that at the end of the day, when you invest in Asia itself, right, I do think that even though we are focused on value and cyclical sectors, don't forget at the end of the day, Asia is the home for a lot of high yielding assets out there. This chart itself basically highlights the fact that as a percentage of the total MSCI All Country World Index, Asia ex Japan has one of the highest representations of the higher yielding assets. Hence, when you think about some of our portfolios that are geared towards growth, we also have income generating portfolios as well. For example, our flagship fund, APDI, for example, which generates quite decent capital growth with income as well. And that's the highlight of this fund here. I don't want to spend much time. I think you can talk to your salespeople out there. But for marketing purposes, I just want to tell you that basically this fund is up by 20% over the last 5 years. You invested in it, it's up by 70%, and it gives very, very decent yield of between 2.5 to 3.5% on a sustainable basis. So I think if you think about growth and you think about income and you think about the fact that basically you want to invest in both sides of growth and income, this is a particular fund that you should think about. The other fund that we funds, one of the best performing funds in the marketplace by Lipper rankings, is Asia Pacific Dynamic Growth Fund. If you believe the story that I just told you about Asia itself, this is a little bit higher risk where we put more a significant bets, for example, in high companies like Samsung, TSMC, LG Chem, and so forth. It's up by 32% last year. I'm not saying it's going to go up by 32% this year, but I do think the trend is your friend, and I do think that the market is up by, the fund is up by 6.5% year to date already. It continues to have very, very strong momentum, and its track record remains very, very commendable. It was launched since I joined 2016, and I think it's done very, very well since then, right? Up about 85% since inception. Moving on from the theme on recovery, I want to focus on my other areas which I like a lot as well, and that is on the revitalization theme. I do think why when I thought about this theme itself is what do we want to invest when you think about this theme itself. And I started to think about, for example, ASEAN and small caps. Why do I like ASEAN? Well, not because I live in Malaysia and I'm part of ASEAN. I travel quite a fair bit down here and I know the markets very, very well. Essentially, I think it has been ignored for too long, right? If you look at the right-hand side chart here, since 2013, for example, ASEAN has been a big underdog versus the North Asian market itself. It started to come alive in November. And I do think that if you are a long-term investor that believes in the long-term growth of Southeast Asia, particularly when you think about an environment where it has underperformed quite substantially from a dollar basis, if you can see this chart down here. But more importantly, when you think about its exposure that it gives you, whether it's through exports, tourist arrivals, and the fact that it has very, very strong current account surplus. But more importantly, I do think that when you think about ASEAN itself, it is going to be basically a mini China, so to speak, right? Where the demographic dividend that you're getting from Indonesia and Thailand and Philippines, for example, or even to an extent Vietnam, is going to propel, for example, the e-commerce penetrations that you're seeing in ASEAN. And this chart on the right-hand side speaks volumes of the fact that how e-commerce penetration is going to rise over the longer term, where you compare, for example, either to China or, for example, to the Western markets where e-commerce as a penetration to its population itself is still in infancy. You can see the chart itself. China itself is 20% of its population is already e-commerce penetrated. In markets like Malaysia and so forth, it's only less than 5%. I do think that this phenomenon will continue. We'll probably hear a lot more news flow towards the third or fourth quarter this year, where we get more and more e-commerce companies being listed. To give you an example, for example, C Limited, which is the owner of your Shopee, for example, was listed on the NASDAQ, I believe, right? Last year, it was up about 100% or 100%, right? And contributed significant growth to some of our portfolios, especially the ASEAN fund. So I do think this phenomenon will continue, and we want to be weighted in this kind of areas in e-commerce. The other thing which I like about ASEAN, which is the high growth markets, for example, besides the traditional 6 markets that I talked about earlier on, is Vietnam, right? Not because the food is good and tourism is good and so forth, but I do think at the end of the day, Vietnam has always been a mini China where it gives you exposure towards the firstly the big transition of China's supply chains into Vietnam, particularly in the electronic sector, and also towards some of the footwear and clothing materials, which traditionally has been benefiting Vietnam. But I do think that the income generating from all these FDIs, for example, into wages and so forth, will continue to drive the long-term trends of the growth in Vietnam. Vietnam has been growing at close to 6 to 8% clip every single year. It's one of the best performing markets last year, despite COVID. He has been managing the COVID as well as the Chinese economy. In fact, this year itself, apart from the last 2 days when it started to correct a little bit, but I do think Vietnam has been one of the biggest outperformers out there in ASEAN markets. And we think that it continues to be a very strong structural play for us, particularly when you believe in the growth trajectory of Vietnam. This is a bit of a marketing again. This is our flagship ASEAN fund. We can see down here, first and foremost, very commendable high single-digit returns last year in the marketplace where MSCI ASEAN was down by 15%. We generate positive returns. And you can see down here, we are now focused on the e-commerce sector with C Limited, and the rest is where we said that we believe in the banking sector as well, which we think is are very, very undervalued. And so hence the reason why we put our money where our mouth is, and also Minor International, which is a tourism play in Thailand, which owns the Anantara chain, for example. So this is something that you want to think about when you think about investing in ASEAN. More importantly as well, I'm a big bull on China, I've always been. And I do think that I don't want to reiterate the whole story about China. Some of you have invested in a Greater China Fund will know that at the end of the day, I talk a lot about consumption. I talk about tech, I talk about finance. I think the dual circulation theme that's happening in China is very real. In case you don't realize, China reinvents itself every decade. And it started every single time when we have a crisis. The last time they did that was 2009 and 2010. And the next decade itself, I think you will see and hear a lot more of the teams on consumption team taking second stage. Secondly, I do think that the tech self-sufficiency post the Huawei issues that we've learned about and talked about a lot will accelerate than we think. And that portends itself for a lot of opportunities and investments, either through cloud computing, data centers, fintech services, online entertainment, you name it, 5G and so forth. I do think this trend will continue and for the next decade. And so please don't jump off the boat so too early, because I do think this story is still at its infancy stage. At the end of the day, also at the same time, when you think about the new age of urbanization and we go to Shanghai or Beijing, for example, you will hear a lot about how China is transforming itself into key city centers for 5G, right? And I do believe very, very strongly that China is going to be the front line of the 5G penetration that you're seeing globally. It is going to be a 5G, especially in clusters like the Yangtze River there and so forth, but particularly in the Greater Bay Area, for example, which we have fun to give you exposure to. But I do think that this is a phenomenon that is going to not last just a multi-year story, but a multi-decade story as well. And more importantly as well, of late, you've heard Xi Jinping talking about how he wants to transform his economy from being less green to more green, and to sustain its economy, right? And I do think that we are now in the process of looking out for a lot more renewable sectors to invest in, not just in our China portfolios, but also in our Asia, as well as also indirectly through our supply chains in ASEAN as well. So I think that's something to watch out for. And I do think that China, as it aims to be carbon neutral by 2060, for example, it's still a long way to go, but essentially that's the way to go, because you need to have a goal. And I think that this is where I think China is going to start thinking about that, and it has repercussions on certain sectors like renewable. This is our flagship fund. For those of you who invest in this fund, it's a spectacular fund. It's up by 30% last year on a 1-year basis, 38, 3 years, 44. And it is one of the largest Greater China funds out there that gives you exposure to the Greater China area, which is basically onshore A-shares, Hong Kong market, as well as Taiwan. You can see down here, our biggest exposure is TSMC and Alibaba, Tencent, and so forth, which gives you a huge upside to the technology sector, as well as the new high growth areas, for example, like EV cars like BYD and so forth, right? And so I do think this is a fund that gives you a direct exposure to large cap stocks in China. Okay, moving on. This is a bit of a more philosophical view of how we look at investments going forward, but you will probably hear a lot more of us talking about renewal of the economies and so forth. But I do think that this are the three big picture themes that we want to talk about post-pandemic, where we shift towards a more digital transformation, where we either is going to be fintech. We all know about fintech already. I don't want to talk too much that, but I want to spend a bit more time talking about, for example, 5G. I want to talk a little bit about healthcare and biotech, for example, right? And so when you think about biotech itself, what does it really mean? It really means that with the whole pandemic issues that we've had over the last year itself, it has basically changed the way people like ourselves looking at the way we want to live our lives, right? And so particularly in an environment where aging populations continue to persist, for example, in China and Europe and the US, and also to a certain extent in certain countries like Thailand, for example. And so as aging populations continue to rise, these demographic trends will push a lot of pharmaceutical companies or biotech companies to increase even faster rate of their R&D, for example, to focus on building new drug discoveries to support future growth. And it has led to, for example, the biggest phenomenon where innovation continues to persist in the drug area, for example. I mean, in history itself, no a biotech company has come out with a vaccine that fast compared to the COVID-19 vaccines from Pfizer and Moderna and the rest of the other biotech companies out there. I do think that this is not going to just be focused on this particular pandemic, but I do think that innovative drugs, for example, cancer research and other incurable conditions, for example, will continue to persist. And I do think that this phenomenon, for example, will continue. You'll probably hear about this sooner rather than later, where we launch our biotech fund, for example. And I think that you want to get in touch with our salespeople about this, because I do think this is going to be a very interesting space to be in. The next big thing, I think, is 5G. And I think this is an unstoppable trend for the next decade or two, where I do think that you can see down here in the initial stages, where market has forecasted a huge amount of demand for global 5G network infrastructures, for example, and also towards how it would then portend for the network of connected devices, but more importantly, how 5G will transform the way business will transform itself. Whether, for example, what I've seen, for example, where 5G has now have used, for example, cloud computing to control robotics in factories and so forth, and even autonomous cars, or whether it's going to be cloud computing network and so forth. I do think that this is something which is going to be driving the way we progress going forward, right? Similar to how we think about, for example, 3G or 4G was initially, right? I do think 5G is going to be a very exciting space. So keep out, watch out for that. I do think at the end of the day, as I mentioned early on, the other third key pillar when I think about sustainability as well is also on sustainable investments. European asset management companies and the European nations, for example, have a European asset management company, and they were one of the largest proponents, for example, for sustainable investment. This has now led to, for example, to huge initiatives by the US government now. And I do think that this phenomenon will also start to roll over to the Asian countries itself. And you can see down here, people will ask me that is socially responsible investments weaker in terms of performance versus the conventional active fund managers out there. I do think that this in itself will tell you that at the end of the day, sustainable investments is here to stay. It reminds me a little bit about 20 years ago when I started my career, where exchange traded funds was the hype at that time. And you roll forward 20 years later, passive investments continue to be key proponent of how it drives markets and AUMs across all major asset management, or if not pension funds across the world. And I do think that sustainable investments over the next decade is going to be something to look out for as well. So just to highlight in terms of technology itself, this is our global technology fund. It is now close to about 1.35 billion in AUM. He's done spectacularly well last year, up by 48% and about 80% since its inception. It gives you exposure to all the major global tech companies. And I do think that it also gives you exposure to some of the 5G initiatives that we talk about, and to a certain extent also biotech as well. So yeah, so that's the. So where do we go from here? As I always say, right? A wise guy used to tell me this, right? The trend is your friend, right? I mean, it sounds very simplistic, but this chart tells you, the real story, right? you know, Even despite the fact that we had a massive sell-off in March, even if you had bought at the top end of February or March last year, you will still be making money up until today, whether it's US high growth, emerging market Asia, US value, emerging markets Asia, and so forth, right? So I do think this trend will continue. Why do I think it will continue? Simply because I think that monetary policy continues to be very, very liquid globally. I do think that the way your FD rates are going, which is so low, essentially a lot of investors will take money out and basically go out there and invest to get higher returns. The second key point is a lot of clients ask me this question itself: are we in very exuberant areas now in equity markets? And the comparison here is that I don't think we're anywhere close to the hype of where we are in 2017, and that was the beginning of the biggest bull market as well, after the post Lehman Brothers issues in 2008. And I think that this trend will continue. I do think that liquidity is good. And what I'm looking out for at the moment is that as long as the trend continues, I will continue to stay invested. And time again, people have always said that, you're just a marketing whatever, right? And therefore you will always tell people to stay invested. But if you look at this trend itself, right? Why would you want to get in and get out of the market all the time? You stay invested and you'll be fine, because if not, you're gonna and higher. You're going to lose a lot of transaction costs and so forth, right? So I do think as long as we are not in bubble territory in terms of where I think investor positioning is at the moment, right? I do think the rally continues, right? And I just want to end my slides by just saying this, right? In history itself, and I tend to read a little bit more these days, although some of my colleagues or friends who are on the line probably debate about that. But essentially, I've been reading a lot about the Roaring Twenties, right? And the similarity to the Roaring Twenties are very, very similar to where we are in 1920, in 2020 to 2021 to 2021 to and dot dot dot, right? And so this is a chart that tells you everything. Tesla today, market cap, is almost equivalent to the sum of every single market cap of cars globally, whether it's Volkswagen, Mercedes, GM, and so forth. What does it really tell you? Is this a sign of over exuberance by investors? Is this a sign that people are focused too much on new technologies like EV cars and so forth? Is this a sign that people do not know how to do valuations anymore, when Tesla is still not making money and the rest of these guys are making money, and yet the investors out there continue to pile into Tesla? Well, the long story short is, I'm not so sure. But if we are in the Roaring Twenties, and this is just something to think about, right? Thought leadership. If we are really in the Roaring Twenties, to put things in perspective, the Roaring Twenties happened because there was a 1918 pandemic, one of the worst pandemics ever as well, right? Where it was called the Spanish flu, right? And close to about 500 million people died, 500 million people died over the course of 2 years. It lasted 2 years. But because of the stimulus packages that was put in place, monetary policy was cut a lot. It led to a big boom in economies post-pandemic, where people went out there, they had pent-up demand on consumption. People went out there and started to buy cars for the very first time. And at that time, there was only one company that was selling lots and lots of cars, apart from Ford, right? It was GM Motors. GM Motors at the low of the market time at that time was valued at US dollars $9. Over the next decade, because consumption drove to the roof and people went out there and bought cars. And remember, 1920s, there weren't a lot of cars at that time. And in the same time, there was a lot of electrification, where electricity was the grid was put on space. And in the US itself, there was a lot more usage of electricity, right? And so that led to the industrial boom, for example, over the next decade. GM, for example, went from $9 to $90 at the height, or 95 US dollars before the 1930 crash. So my point here is that I'm not saying that we are in the Roaring Twenties. Maybe we are, maybe we're not. I'm just giving you some thoughts that this is how the market works. People want to pay for new technology stuff. People want to pay for Tesla. People want to pay out for EV cars. They want to pay out for 5G. They want to pay for global tech. They want to pay for high growth countries, for example, like China, Taiwan, and Korea. So I think if you do believe that there's going to be a pent-up demand post this pandemic, who knows? It could be in the biggest bull market ever, right? And so the trend continues, right? And so I think as much as people are postulating that Tesla is overvalued, it's overowned, and so forth, I'll leave you to guys to think about that. But I do think that if we are in similar trends that we were in the roaring 20s, then you want to stay invested, right? So in summary, I do think that the theme on recovery and revitalization is real, where the focus in 2020 was the stay-at-home sectors, where I think in 2021, you want to invest it in funds or sectors that are cyclical, are small cap, and offer you value. I think the rotation will continue. I think in terms of the renewal team, where we talked about, for example, 5G, fintech, and biotech is something that are circular in nature. It's not a one-time thing. I think it's going to be for real, and hence the reason why, like I said, the Teslas of this world are getting more airtime than, for example, maybe even oil and gas company, any old school company, right? Brick and mortar company out there, right? And I do think that in the event you do see any form of correction in the next months to come, the whole thing that you have learned about in 2020 or any form of correction that we've seen, it's never a good time to jump in and jump out. You need to build long-term positions. Of course, at some point you need to take some profits, that's normal. But I do think that you need to use those volatility to build long-term positions for your portfolios, because it's imperative at the end of the day, if you believe, and I do, for example, that if there's any similarities to the 1920s, we are in for a long, long bull market if this happens. And I think this is something to think about.